Welcome back to Lamb's Macroverse. Today we're going to talk about something no one's talking about. So I'm doing two videos. I actually did one already on elasticity of Treasury rates. That's elasticity, I know that's a big word, of Treasury rates and how they move basically. You can look down there to find that video. Today's video is on Treasury maturities. Which Treasury maturity is tied to the Fed funds rate? That's what we want to know in today's video. Most people, by the way, say it's the 2-year note. So let's take a deep dive. So like I said, we're taught that the 2-year Treasury moves with the Fed funds rate. So everyone uses that as a benchmark. And here's a little cartoon here. It says, I used to think correlation implied causation. Then I took a stat class. Now I don't know. Sounds like the class helped. Well, maybe. Each Treasury maturity has an elasticity. An elasticity can tip the balance. By that I mean Treasury rates act a certain way based on what the news is, and some Treasury rates will go up or down a lot depending on their elasticity. Like I said, you can look at the video I did on this that will help explain it, because it's like a long process to explain it to you. So let's forget about that for now. But I want to do, actually there's one more slide here on elasticity of demand. Just one quick note, I should say. It's the measure of responsiveness of one economic variable to another. So in terms of the Treasury yield curve and all the Treasury maturities, it basically dictates which maturity moves more than the other. So if the 30-year maturity, if that bond moves a lot on some economic news, that has a higher elasticity. So let's just leave it at that. So it's not elasticity of demand, it's just elasticity. Yield curve. So there are 2 or 3 different types of yield curves. There's an inverted yield curve, the, I would say, upward rising yield curve. Here they call it normal, and the flat yield curve. Yeah, I would say the flat yield curve, even without looking at the inverted yield curve, I would say that even the flat yield curve is saying caution, there might be a recession coming. And an inverted yield curve says the same thing. Now, the normal yield curve is, it's a normal yield curve. That's what we normally have. And you see this also, not just with the yield curve in terms of treasuries, but you see this also with like commodity futures such as oil, because you have holding costs and things like that. So but my point is, you need to know these curves in order to know what the economy is going to do or what investors think the economy is going to do. So here's a list of Treasury rates. Actually, we have one more maturity which is not here. That's a 20-year maturity. For some reason, this is the Wall Street Journal. For some reason, the Wall Street Journal does not display the 20-year maturity, which I think would be nice. So basically the maturities start obviously in the short term, so that's 1 month, and then a 3, 6 month, and 1 year maturity. And then the name changes from bill to notes until you reach the 30-year bond, and then it's called bond. And what I want to show you is that if you look at the yield column here, and that's the 3rd column here from left to right, actually it's the 4th column, you could see that short-term yields are much higher. You could also see the 2-year note I highlighted here for you, because this is the one that's considered the proxy or benchmark for where the Fed funds rate is and where it's going. I should say where it's going. But I want to point something out to you. As you know, we had this banking crisis, which appears to be over, at least for the time being. And as you know, it started with Signature Bank and Silicon Valley Bank. And at that time, the MOVE index, if you know what the MOVE index, that's like the Treasury index's version of the VIX, the CBOE, the VIX index. So basically, it's a volatility index. At that time, the MOVE index skyrocketed, one of the highest it's ever been. And the 2-year note went from, and you can see it on the chart here on the right side, it went from, I'm rounding numbers out. I'm calling it 5%, going down to below 4%. That is, my friends, one of the biggest declines in known history. And the last time we saw such a big decline was, well, you guessed it, during the 1987 crisis, the 1998 crisis, I believe, and of course the 2001, 2000 tech wreck, and the great financial crisis. So we have more questions than answers. Listen, I'm going on this journey with you because there's no information about this. So I'm like thinking with you, and maybe you can come up with your own ideas, your own answers. So what's the first question? The first question is, the first note is, does the 2-year move with the Fed funds rate? And I'm going, So what is the Fed funds rate, right? How do you know if it's moving, if the 2-year note is moving with the Fed funds rate? We don't even know what the Fed funds rate is. So according to Investopedia, the Fed funds rate is an interest rate set by the Fed to indirectly, that's pretty important, indirectly manage interest rates, inflation, and unemployment. I would say employment. Remember, the two mandates of the Federal Reserve are inflation and employment. Some would say that the government's also responsible for social responsibility. I think not, but that's besides the point. There's a lot of conspiracy theories, maybe not really conspiracy theories. There's a lot of issues out there with what the Federal Reserve of San Francisco was doing in terms of managing the risk of Silicon Valley Bank versus they were working on some ESG issues at the same time in some of their papers that they were talking about. So they need to be, in my opinion, they need to be really focused. And one other thing I want to say, besides what's said here, to me, the number one, I would say, mission of the Fed is to control and influence liquidity. That's it. That's the number one thing they should be doing. So getting back to these questions that I had. So we know what the Fed funds rate is. Actually, I messed up one thing. I should have gone back to that definition on the right side of the panel. And on the right side, it said that the Fed funds rate is an overnight rate. And that's really important. So we're comparing, think about it, an overnight rate that's lent to banks, right? Versus the 2-year rate that's used as a proxy. So something's not adding up. So here's some other questions. Why is it correlated then? Why is a 2-year rate correlated to the Fed funds rate if it's only overnight? And does it move quickly? Well, we saw the answer to that in the previous slide. It does not move quickly, but lately it's moved quick as hell. I mean, it's, like I said, one of the biggest moves in history. So who buys 2-year treasuries? Well, I was asking ChatGPT and Google's Bard, and I didn't get a good answer. I don't know who's buying 2-year treasuries. I'm guessing it's investors like you and me. I don't think it's pension funds because the rate is too short. Or maybe it's Silicon Valley Bank because they want to hedge rising rates. Oops, no. That was a joke. If they did buy 2-year rates or shorter term rates, they wouldn't be in the problem that they're in right now, right? Because when rates rise, short term notes do better. There's less risk because of duration, and the effective maturity is shorter. So I think I covered everything. I do want to talk a little more about why it's correlated. I think I'm going to do this on this slide here. So my guess, all I'm giving you is a guess because there is no research out there for what I'm talking to you about. None that I've seen. So here's what I'm going to tell you. The 2-year maturity, that's the 2-year maturity of the Treasury note, reflects the Fed funds rate at the beginning. So I've capitalized it because I'm stressing beginning. At the beginning of the liquidity tightening regime, also called the rising rate cycle. And this regime began in the beginning of 2022, even before the Fed was raising rates. I think the Fed was raising rates in March of 2022. That was the first rate increase. even though they should have raised rates a year before that. But remember, a year before that, when inflation was soaring, the Fed said they were not even thinking of raising rates. So going back to my point, the rising rate cycle actually started in the beginning of 2022. So I don't mean March 22, even before that, because remember, before the Fed raises rates or does anything, it has the FOMC governors leak out the information. As you know, it's like they're doing a roadshow every week. They're always out speaking. I think they're speaking too much. The Fed went from not speaking at all, I guess about a decade or two ago, to like talking on a weekly basis, which I think is a bit overkill. But going back to my point, so that's how you get the 2-year being a proxy. So the first part of that proxy is that it takes, the beginning of the cycle was in 2022, and it takes over 1.5 years for this. I'm not sure what word you want to use. I like to use regime. That's a word I used in risk management. So a rising rate regime, these regimes don't occur overnight. They tend to last a long time. That's why we call them regimes. And so these regimes, I look back in history, they take at least or about, let's say, 1.5 years. So already we're 2/3 of the way down to getting to your 2-year maturity. So how am I going to fill in that extra 6 months? Here's how. Second point, second bullet. Each federal funds rate hike takes about 1 year, yes, 1 year to affect the economy. And so far we've had 9 hikes. 9 hikes. So think about that. So far the first hike, I think it was a 1/4 basis point, 25 basis points, I should say. That hike was in March of 2022. That means beginning in March, April, that first hike is affecting the economy. So if you think of what I'm thinking, you're realizing that there's a huge lag between when the Fed raises rates and when the economy is affected. And there's more detail to this. I wasn't sure if I should talk to you or even write it down. So I did not write it down, but let me add a little more meat to what I'm talking about. It's not just what I just said, raising rates. You also have to look, are they raising rates into a strong economy? Are they raising rates into a weak economy? Because that could affect the quickness of the rate hikes. And there's another point. Are they raising rates to a monetized economy? Meaning that there's a lot of debt, especially at the sovereign level. Remember, debt has moved. It was more in places like you and me. It's moved from you and me to corporations and up the full chain, up to the federal government, so that the economy, the whole economy, the global economy, I would insist, has become monetized. So it's more sensitive to rate increases. The last point I want to talk to you that's not in the slide is that you also need to consider not just, okay, they're raising a rate hike in March. That's going to affect the economy a year out. You have to consider the amount of the rate rise. So the first rate hike was about 25 basis points, but then it went up to 75 basis points, and then I think 75 again, and then 50 and 50. Obviously, those larger rate hikes are going to affect the economy more. So remember, the economy is going to be affected by various nuances of this rate regime, of this rate rising regime. So again, that's how you get to the 2-year rate. You got the lag effect, which I just mentioned, and that the rate regime cycle takes a long time. So how do we do this? How do we make a proxy that reflects the Fed funds rate? What we need to do is constantly lower the maturity of the proxy that we're using. So we need to lower it on a forward basis. So now that a year has gone by, obviously we're not going to use a 2-year note. So I would suggest that since it's over a year, that we use something like the 6-month T-bill or the 3-month 3-month bill. Now, you might be saying, "Well, Dominic, why aren't we using a longer term rate?" The thing, those longer term rates don't exist. So you can either concatenate and use some type of forward yield curve. You don't need to get fancy like that. You could just look at the 6 month rate or even a 3 month rate. And the reason I'm saying that is if you look at a 3 month rate and a 6 month rate, they're nearly identical. So it does not matter. So I tend to use, besides using the 2 year benchmark and a 210 spread, I just use a 3 month spread as a benchmark. And I don't change it constantly, but I do follow all the rates just to make sure that the 3 month rate is not much different than the 6 month rate and the 1 year rate. What else? So last point I think I just mentioned, if you're looking at the yield spread, right? Everyone uses a 210. So if you're using a yield spread as a recession predictor, you must look at the 3 month versus the 10 year, or the 6 month versus the 10 year, or the 1 year versus the 10 year, and the 3 month versus the 30 year spread. Do not use the 2 year versus the 10 year or the 230. So here's this historical data. This comes from Fred. This is a St. Louis Fed database, and I went through each of these cycles, and that's how I calculated all the data that I just presented to you. And you can do this yourself and take a look at it. But you could see, just one note, you could see that back in the 70s when we had a lot of inflation, that the Fed funds rate was very high. And what you can't see here is that the Fed funds rate was greater. It was over the CPI. This time around, the Fed funds rate is below the CPI, which is not a good thing. But like I explained to you earlier, let me just grab a drink here. Like I said earlier, the economy is monetized. So because it's monetized, I believe the Fed doesn't need to raise the Fed funds rate above CPI. Next slide. So I went back and I found a whole bunch of data on each rising rate regime and each lower rate regime. In other words, I looked at regimes with higher liquidity and lower liquidity. So I'm just giving you one example here. This was a big or long and large tightening of liquidity, and it occurred. You have to remember, you always need to look at the historical background. So if you recall, there was a tech wreck in beginning of March 15, I believe, of 2000, with the NASDAQ crashing. And then we had the 9/11, and then we had a big recession, and then we had Enron, and then all these companies blow up, and the electric utility crisis. But so what happened was the Fed lowered rates. So after the Fed lowered rates, the economy picked up by 2003, I believe. And so by 2004, the Fed needed to raise rates, and you could see all the I shouldn't say aggressive, you could see all the incremental increases in Fed rate changes. So we had all 25 bips, 25 basis point increases. So pretty small but consistent increases in rates. But you can see, my point is that it took a long time to raise those rates. So what does Google's bar, that's the AI from Google, what does it say? I looked up this question, tell me the Treasury Maturity most closely tied to the Fed funds rate, and it gave me at least 3 or 4 incorrect answers. So I do not like using AI. It does not give correct data, at least for me. So they're saying to use a 2-year Treasury note, but they gave me all different answers. I did this question multiple times. So here's some recent yield spread history. And if you look here, you could see that, I'm putting my point here, that the 2-year note went down sharply. And we talked about that already. It hit a peak of 5% on March 7th, and now it's below 4%. And this is based on April 7th's labor report, which was a little more hawkish than expected, slightly more hawkish. But what my point to you is that if you're looking at the 210 spread, you can see that the spread would hit a high of 105 basis points, which means a recession is probably coming. But now it's much lower. It's only in the 50s. It's about 50 to 56 basis points. But if you're looking at the 10-year minus 3-month, or the 310, we should say 3-month, 10-year, we hit a new high, or I should say new low in that spread. So to me, that's telling you there's a recession coming, that there's a higher probability of a recession coming. So if you could see what I also did is I didn't just look at one spread. I calculate 3 spreads. Actually, what I should do is calculate 4 or 5 spreads. The 1-year spread, the 30-year and 10-year versus 1 year, and the 30-year and 10-year versus 6 months. That's the proper way of doing it, but I don't want to complicate things. So what are the counter arguments to my theory? There's multiple theories that explain a yield curve. Expectations theory, what do people think it's going to happen? What's expectations for inflation? What's the expectations for credit risk for the U.S. economy as a sovereign, I should say? Liquidity preference. Where's all the liquidity, right? Also, think about over time. If you're think about a corporation. If you're lending money to a corporation and you're lending money over like 1 day or 1 week, there's very little risk in terms of maturity. But if you're lending money to a corporation for 30 years, think about all the shit that could happen, all the shit that could hit the fan, and the corporation could go bust by then. That's part of the liquidity preference theory. And then you have market segmentations. Just think about your mortgage. Think about it. Your 30-year mortgage, it's not based on a 30-year bond. It's based on a 10-year note. That's an example of the market segmentations theory. So how can the federal funds rate equivalent Treasury maturity, meaning the proxies I just told you about, the shorter term proxies, like 3 months, 6 months, how can they be utilized to help you with your strategic portfolio allocation? Well, if the adjusted yield curve, meaning for example, 3 months, 10 years, remains negative, we can still assume that there's an economic slowdown or recession coming. So what you could do is tilt your portfolio towards what you think are defensive sectors. So you could make the judgment of that. This is not financial advice. I'm guessing maybe it's precious metals, maybe it's staples, maybe it's healthcare, utilities, or even treasuries. So that's what I'm guessing. Maybe that's where you can put a higher weighting of your portfolio. So that's it for now. So remember, don't be conventional. Think outside the box and think about what Wayne Gretzky said. I almost said Wayne's World. He said he skates to where the puck's going. That's not where it's been. So try not to rely too much on Twitter and LinkedIn and Discord and Telegram, because what they do is they repeat. They play Monday night quarterback and they repeat what just happened, like Silicon Valley Bank. That's all everyone's talking about. The banking crisis, unrealized losses. We can do better than that. Let's look forward, my friends. And remember, speaking of banking crisis, that banking crisis has increased the probability of recession, because no matter how much liquidity that is being thrown at you guys, at everyone, and how much superficial liquidity we're seeing from a higher Fed balance sheet and a discount window, there is actually lower liquidity because banks are increasing their lending standards. They're making it tougher for corporations and even people like you and me to borrow money. And remember, the Fed's likely to hold rates higher for longer. So just keep that in mind. Thank you all for listening. I know this was a lot to digest, and if you like it or don't like it, please hit the like button below and don't forget to subscribe to us. Adios and thank you. Bye-bye.